Currency depreciation does not have any meaningful impact on investment performance. We'll understand why. First, let us look at why a currency depreciates. What is the underlying logic behind it? So, if we take example of Indian rupee, we are used to seeing it depreciating consistently vis-a-vis stronger currencies like US dollar, euro, and others. So, what is the primary reason that Indian currency keeps on depreciating vis-a-vis these stronger currencies? The underlying reason is inflation. If you look at the inflation in India today, it's about 5 to 6% trend line inflation. Vis-a-vis, if you look at trend line inflation in Eurozone or the US, there it's about 2 to 3 percentage. So there is a 3 to 4 percentage differential, which is higher in India vis-a-vis them. This differential of inflation feeds into currency depreciation. If we look at historical example, between 2010 to 2025, in the last 15 years, on an average, Indian inflation was higher vis-a-vis US and Eurozone by about 4 percentage. So technically, in this period, Indian rupee should have depreciated close to 4 percentage per annum on an average for the parity to hold. If we look at the data, Indian rupee did depreciate closer to that particular amount. Now, let's understand why currency depreciation does not have any meaningful impact on the investment performance. So, suppose this foreign investor wants to invest about $100,000 in India back in 2015. So, he would have converted his currency to rupee terms back then, and it would have fetched him 63 lakh rupees. This 63 lakhs he would have invested in Nifty 500 index fund, which would have grown to about 1.9 crore today. If he wants to take this money back today, he will redeem his investment, convert that to USD at the prevalent exchange rate, which is about 87. So he will take home about 2.2 lakh dollars. So essentially, his $100,000 grew to about 2.2 lakh dollars over the last 10 years. This translates to a CAGR return of about 8.2%. Imagine if he had not invested in India and he would have invested in US itself in 2015, and say he invested this money in S&P 500, his $100,000 would have grown to about $265,000 as we speak. This translated to about 10.9 to 11% CAGR gains. Please understand that Indian markets have underwent a correction in the last 4-5 months. The current returns are slightly on the lower side. On the contrary, US markets are still going through a bull phase. So returns of 11% that we have calculated is slightly on the higher side. If we do the same exercise for India, for say end of September 2024, you will see that from India also he would have earned about 11% return in INR terms. So what we can conclude from this example is his returns in India did not get impacted by the depreciation of Indian rupee, which went from about 63 to 87 in the last 10 years, from 2015 to 2025. So if inflation is the underlying driver of currency depreciation and Indian inflation is expected to be higher in the coming decades, and Indian rupee is expected to consistently depreciate vis-a-vis stronger currencies like USD and Euro, and as we saw that it doesn't have any meaningful impact on long-term investments, then why do investors get jittery about currency depreciation when it plays out? The prima facie reason behind this is currency depreciation is not gradual. You will never see that Indian rupee has consistently depreciated 3 to 4 percentage every year vis-a-vis US dollars. It tends to stay stagnant for 2 to 3 years, and then one fine year it suddenly drops by 10 12 percentage, and then the similar trend continues in the future. So when a foreign or an NRI investor experiences that particular year where there is a sudden drop in the exchange rate, he gets mentally discomforted with this entire scenario. His behavioral bias is accentuated by the fact that generally this kind of depreciation years coincides when the Indian markets are not doing well. So for example, if you take the example of 2022 or say 2024-25, Uh, when equity markets were not doing well, actually the depreciation of 10 to 12 percentage happened during that time period. And historically, it has been like that only. So if an investor is not seeing his investments doing well, and at the same time a portion of returns being wiped off because of currency depreciation, behaviorally it impacts him a lot. But the thing is, this is temporary. This is just for that time period. If the investor remains invested for the entire cycle, his investments would incur the expected range of return that is expected from the underlying investments. Many foreign investors tend to double count inflation and depreciation. So, in our practice, again, we have encountered many examples where the investors have come back to us and they have said that if we expect, say, 13 to 15 percentage from Indian markets and we have 6 percentage inflation, another 5 6 percentage goes towards depreciation. So, technically, they are left with very less real returns post inflation and depreciation. So there is a flaw in this argument. Firstly, depreciation is already ingrained in inflation. So it is not on and above inflation. Secondly, depreciation is in the range of 3 to 4% and not higher than that. Historically, also, it has been in this particular range. So we have to understand that if Indian markets are giving you, say, 15 percentage and the expected inflation is 6 percentage, then technically you are earning a 9% real return from the Indian markets. 15 minus 6 equal to 9%. If you do this exercise in USD, so if 15 percentage is the expected return from the Indian market in rupee terms, the equivalent USD denominated return would be 4% lower because that 4% will feed into currency depreciation. So the expected return in USD terms would be 11 percentage. And because the inflation in US is about 2 percentage, so you deduct 2 percentage from that and you're left with 9 percentage real return. So real return remains the same irrespective of which currency you are doing the calculation from. So inflation in India is equal to inflation in US plus the currency depreciation expected vis-a-vis USD and INR. So mentally, we should not double count inflation and depreciation. Uh, Depreciation is already ingrained in the inflation formula. So what we can conclude from this discussion is currency appreciation and depreciation is part and parcel of forex markets. They don't have any meaningful impact on the long-term investment performance. Hence, your investment decision should not be guided by the expectation of currency appreciation or depreciation. It should only be guided by your investor profile, your asset allocation, the diversification in the equity portfolio, and the necessary rebalancings that need to be done.